Hey, it's John Terry with Vision Advisors. Let me say thank you for taking time out of your schedule. Whether you're having an opportunity to listen to this as a live event as we're doing it today, or you're going to catch this on our YouTube or one of our other social media channels, thank you for taking the time to learn a little bit more and diving deeper to improve yourself. You know, there's a statement that Ray Kroc said years ago that I think is valuable, and he said this. He said, as long as you're green, you're growing. But once you're ripe, you start to rot. And one of the most important things that we can do as financial professionals is continue to invest in ourselves and continue to grow ourselves. And that's one of the reasons that we at Vision Advisors are constantly putting forth opportunities for you to learn about new product, new sales ideas, new enhancements, new strategies, new ways to get in front of qualified prospects, because we want to stretch you and move you beyond the status quo so that you've got an opportunity to improve and leverage. You know, we're really excited about our relationship that we have with Legacy Marketing Group. They are one of our go-to players in the marketplace because they bring innovative solutions that really nobody else offers anything to compete with. You know, there's a lot of shelf products that's out there that is kind of the Me Too version of products. But one of the things I like about Legacy is that they bring innovation to the industry, and they bring some uniqueness to the industry. And I have on the call with me today James Marco, one of the regionals that works with Legacy. James is a good friend of Vision, and many of you have had an opportunity to sit in on an event that James has been at. He's a great guy. But today we want to talk about some enhancements. I was excited when I attended the IMO conference earlier in the year to learn about some of the things we're going to share with you today. And just a few minutes ago, we finished debriefing our team on some of these enhancements, and they're excited about what you're going to hear. So without further ado, let me toss this over to James and give you an opportunity to hear firsthand about some new and innovative strategies that are going to give you a chance to grow your practice, to have a new story, and to be able to share something that is absolutely amazing and something that's going to be good for your client. So James, thanks for joining us. I'm going to flip it over to you, and I may jump in from time to time and share something as we go through, but very excited about today's webinar.
Thank you, John, for that. And please do feel to chime in and reiterate some of these nuggets or sweet spots. We do have some exciting new things I'm going to share right now. My call to action is, there's actually a lot I'm going to lay out here. Call Vision Advisors, take some notes, get some nuggets. You're going to like what you're going to see here. And then follow up. If you want to, I got to gloss over or just kind of give you the broader overview of some of these new things that we're offering. And then if you want to get the detail, call Vision Advisors. You're going to like what you're going to, the more you dig, the more gold you're going to find. So let's do an overview, but I'd give them a call if you want to get more specifics. And this is you're getting the premier version, if you will, of a webinar. We're launching 3 fantastic new enhancements. From our webinar invite, there are 3 enhancements that will boost your sales. And basically, are you offering your clients 7% fully credited day 1 bonuses on a paper? Are you offering your client strategies that credit annually and give you more upside than just your traditional annual point-to-point? So we have some big news. One is big bonus, and we also have an index with 2 new strategies being added to Legacy's #1 product. So again, I'm James Marco. Enough on me. I've been with Legacy for 10 years. Some of you I've met. Others, thank you for joining us here. Give Vision a call and we can dig more into the new things from Legacy. So this is cutting edge, if you will. We got 3 new things that are going to be exciting. And more importantly, that are going to boost your sales. It's what I say, it's what clients want. The product series has one of the best minimum guarantees in the marketplace. 1.6 minimum guarantee on 100% of the money. It's quantifiable, it's tangible, it's easy to tell a client. You put $100,000 in, 10 years later, worst case, that's $117,203. Worst case, a real minimum guarantee. Kind of like the value propositions for some of you who sold index annuities 15 or 20 years ago, a real minimum guarantee or the greater of the performance of the product. If this resonates with you more, $1 million goes in, worst case later, 10 years later on a 1.6 guarantee, that's $1,172,000 in change, or the greater of your account value, which should blow it away. So we have the best, in my opinion, and most straightforward minimum guarantee, And then we have tremendous upside that I'll show you here, the best of both worlds, if you will. John alluded to, so Legacy's been doing this for 25 years. Americo's the carrier. They're exactly what you're looking for. A-rated, Midwest-based. They're over 100 years old. Check, check, check across the board. Legacy for 25 years partners with carriers like Americo, good reputation, highly rated. And we built our products from the ground up. And our number one selling product, the Liberty Mark here, is getting some exciting new things. A bigger bonus. Bonuses sell. Clients like big bonuses. We're still going to have the no bonus version, but now we have an exciting and enhanced bigger bonus version. This will definitely get some interest from your clients. We have a game-changing new index with 2 strategies, so 2 new strategies to our kind of our number one product, if you will, with a bunch of other great strategies that I won't give a whole lot of love to now because we got too many new things to talk about. And we have a new easy to use illustration interface. Illustrations look better, they're easier to use, or I'd say put vision to work or put the legacy people at work. We'll help you run and or do those illustrations and point out where on the illustration a lot of our agents do the selling. They do the minimum guarantee. Here's the 1.6, it's a standout feature. This is the worst case, and then they show the illustration of kind of low, medium, and high. Sell the minimum guarantee offer and say, but here's a shot at a reasonable rate of return. And I think it's what clients truly want. Give me a real tangible minimum guarantee with a shot at a reasonable rate of return. And a lot of people out there will be happy campers. They're not going to make a bunch of money or double their money or lose their money overnight. It's the cornerstones of a fixed index annuity. Give me a guarantee and give me some upside potential. They'll get the greater of that. So I think what's going to really give a lot of pop and interest is our bigger premium bonus coming here May 1st, 2019. Again, if you're on social media, I don't know where you're at in time, but this is launching May 1st, 2019. We had a 5% upfront, 10% back-end bonus, and most states are light states. If you're familiar with light, meaning California, Texas, Florida. If you're not in a light state, congratulations. You got you're going to be fine. You don't have to worry about it. Our light states had a little bit smaller back-end bonus. Well, guess what? We're going to change it to a new 7% upfront, meaning fully credited day one, $1, meaning fully vested all the way right out of the gate, if you know what that means. If you don't know what a vesting bonus is, you don't have to worry about it. We don't have that. We have the old-fashioned kind, the kind you liked. That was easy to explain. It's 7% credited immediately and in full. It's 6% here where I'm in California. It's a robust, immediately credited bonus all the way, and it's going to do a lot for the clients. And we at Legacy, we believe it's better to be upfront. That's our philosophy. And there's advantages to having an upfront, fully credited bonus. It's easy to explain. You don't have to worry about this vesting or I've been there. Have you been with a client where you have this account and the bonus account on the other page? You explain the bonus account's doing this and working its way over. You don't have to worry about any of that. It's just credited right away. There's no wait for 10 years to work its way over. It can offset surrender charges upon replacement. A nice big 7% bonus. I mean, what happens when the people are interested in that regardless, but when the market does a little correction or fluctuation, what's your biggest upfront bonus that's going to boom? Well, this is going to be a nice upfront one. It obviously springboards growth from day one. There it is, and we're just going to compound interest or a rate of return on top of that. This is a big one for me. There's no stakes in the grass, I call it. There's not a vesting schedule. There's not a clawback or what if I surrender 7 years in the contract? Are they going to take away my bonus? Or what if I make a withdrawal? Is there a retroactive withdrawal, take back? All those things that we don't really like or appreciate, or I call the snakes in the grass, they're totally eliminated. There is none of that. There's no vesting. There's no clawbacks. There's nothing funny, if you will. It's clean. It's clear. Annual statements, the bonus goes in there immediately, and off we go. Next year, hopefully we have some compounding on top of that bonus. But you actually have the bonus in your hip pocket immediately. It's available for withdrawal or surrender. This particular product is 10% built in after the first year. So after the first year, you know you're going to have at least 7% or some crediting. It's part of the death benefit. It's available for surrender, withdrawal, it's a real bonus, if that's one way I can phrase it. You can offset prior stock market losses, and it's on our number one selling product. And we can go, you want to call Vision to go deeper on it, but we have two products, a no fee product with no fees on it at all. And then the Liberty Mark has a fee built in that buys up the rates and caps and does a lot of wonderful things. Call Vision Advisors to go through why the fee is good. We have clients who just had their 2-year cycle and our Liberty Mark product get between 15 to 30% returns net of fee. So you'll want to have a conversation about, regardless of the fee, how does it work? You have the same minimum guarantee, you have upside potential, and we have a nice big bonus of 7% that will pay for a small fee to buy the upside along the way. So there's some true innovation. John, anything you want to chime in on the bonus before I move into the next topic, which is our new index and strategies? Anything to add, please?
No, I think, the fact that it's a true upfront bonus and you don't have a vesting schedule gives your clients the opportunity to really see the bang from that benefit day one. And the fact that it's available for surrenders, it's available for withdrawal, it really gives them, especially if you've got a client that's going to be retiring in just a few years and they need that little extra oomph to kind of get them over the hump. This is a great opportunity to use a upfront true bonus to have an opportunity to really get them the dollars that they need that might make the difference between being able to meet all of their expenses and retire on time or having to wait and retire a little bit later.
Excellent. And it's available through issue age 80, but you'll want to check in your state which version, if it's 6 or 7, double check the age. Again, call Vision to double check. It's all going to be good news across the board. Big bonuses do sell, and we have a nice one. We had an IMO meeting recently, and we had, if you heard of Cheryl Moore, she's kind of an industry guru expert. She has wink.com, and she's one of the gurus on life and annuities. And she was there and said basically, yeah, I don't know of any bonuses on a paper that are that robust, that are fully credited. They're all gone to the vesting, and we all know there's nothing wrong with vesting, but again, this is easier, it's cleaner. There's no, what if I surrender early? All these little objections and concerns are totally eliminated with a fully credited bonus right out of the way. Very kind of familiar, indicative of those products, again, from 15, 20 years ago. So we have true innovation. We're bringing some new cutting edge true innovation to the table here. We're also bringing back some things you might like from days past. Quantifiable, tangible, real minimum guarantee, and also a bonus that fully credits right away, just immediately. So that's going to give you the flavor of what you liked from years past. But now we also have some modern or cutting edge things, including some nice new indices. On that note, if you look at the index strategy evolution, 15, 20 years ago, a lot of products had an annual point-to-point with the cap. It was a much higher interest rate environment. It was a pretty good cap back in those days. And they usually had a fixed bucket. That was kind of the first index annuities. You had maybe 2 or 3 strategies or in a fixed bucket. Over time, as interest rates went down, a lot of our annual point-to-point, some of our favorite strategies with the cap, they've gone down as well. There's 1-year gain triggers. That came out a little bit later, where if the index is up just a tiny bit, it will just give you a declared rate. So those were real popular. That was that much more simple. Markets up, you get this rate. Markets down, you get 0. But again, as interest rates went down, these got a little bit harder to price, and the caps came down as well. And if you look at the chart, that's kind of the trend. It's gone up a little bit recently, but throughout time. So what we did as an industry, we came out with some other strategies without a cap. A 1-year point-to-point with par. On a 1-year basis, those are nice. They're a little harder to price. So this Liberty Mark product, the #1 allocated strategy to date anyways, is we have a 2-year old-fashioned S&P point-to-point on the S&P with a par rate. Give Vision a call because we have phenomenal results. You can get the piece showing what real clients got on real statements between 15 to 30%. So people really like the upside, and we have the numbers to prove it, of a multi-year strategy with no cap. The objection to the multi-year strategy is I have to wait till after maybe a couple years to see a return. I like the upside of the multi-year, but I don't like waiting to get there. I like the annual point-to-point because it's consistent and it credits every year, either going to get something or 0. I like the consistency of 1-year strategies but I like the upside of multi-year strategies. Well, what if you could have the best of all worlds? What if you could fuse together what you like about an annual or just a gain trigger, the simplicity if the index is up, you get this declared rate, a multi-year rate lock-in. If we have a multi-year strategy, you're going to have that same rate or par rate locked in. There's no moving parts for that multi-year duration. You're getting the upside of a multi-year strategy. If I can give you something annual crediting and then a big return at the end of the strategy, we're going to try to fuse together and really overcome the multi-year objection. People like multi-year strategies due to the upside. It's just I have to wait to get there. We're going to put all these things together and something that's totally different and unlike any other strategy you've seen. It's the best of both worlds. You're getting potentially a fixed rate credited every year, part of the death benefit available for withdrawal. It's on the statement, yet the upside of a multi-year strategy basically fused together. Hence, we are calling the fusion strategy. It's innovative, it's unique. There's really nothing out there. Don't be mainstream. This is unprecedented, and it's kind of a game-changing new strategy that we're adding to our top product with a bunch of great strategies. It's only good news, really. So the combination of annual, multi-year upside, bringing it all together, if you like a visual, like a pie chart. It's the best of all the worlds. So we're going to have a fixed rate on gain, an annual fixed rate. Index goes up. We're going to credit you on an annual basis. Then the return is real. It's part of the account value, part of the death benefit, part of withdrawal. You keep nodding your head up and down. There's a 4-year rate lock. There's no moving parts. So again, this is a 5-year strategy that credits every year for 4 years, potentially, to give you a big number at the end of 5 years. Again, the 5-year strategy, people don't want to wait that long. I think we've overcome the objection in 2 folds. One is this credits at the date of death. If you have an older client, what if my client dies 4.5 years into a 5-year strategy? I'm afraid of that. Don't worry. We'll measure that date of death, whether it's 6 months or 4.5 years in the strategy. If they don't make it to the end of 5 years, we'll use the date of death as like an anniversary or the end of cycle at any point, and we'll apply any gains. Feel free to use a multi-year strategy with any age client. We can overcome that concern or objection. Also, everything's locked in, and we're going to give you crediting along the way. So instead of waiting for 5 years and seeing nothing, we're going to credit every year to give you hopefully a big one. So it overcomes that. Here's a quick example. Here's the key here, and I want you, and I already just spoke with Vision, is the starting index value. It's more important to be above this line than it is. So from year to year, as long as the index goes up at all, they're getting a fixed rate on grain credit. It's going to be 5%. And I'll show you in a second. It's good. It's 5, but I want to explain that in a moment. If this goes down below the starting index value, in this scenario, they get 0 that year. In year 3, if it's above the initial starting point, of course, we're going to give that crediting in that year. In year 4, let's say instead of this line going up, let's say from year 3 to year 4, the index is flat or even down slightly. Even though it's down from the previous year, as long as it's above the initial starting index value, it's going to credit. This chart, we could shoot way up here, and every couple of years it could continue going down compared to year 1. It just needs to be above this initial starting index value, and we'll credit that. Then finally, again, 5%, 0, 5, 5, and at the end of the 5th year, we'll apply the par rate. It's uncapped, and get that big multi-year pop that we're looking for. Let me describe in some hard dollars and numbers. John, you're going to want to feel free to jump in or reiterate anything I'm saying on here.
Yeah. Hey, James, can you jump back to the other slide real quick for just a second?
You got it,
One
sir.
that you just came
Let's
back
go.
to. I think the big thing that I get, my takeaway from that, is that starting index value really becomes the benchmark from where the crediting strategy is going to take place. And in the past, we've always talked about, whether the index is up or down. And one of the things that you're hearing James say, and I think it's important you catch it, is this is above or below that index starting value. So wherever they start at the end of year 1, that's going to be the measuring stick for the remaining 4 years. So it's a little different thinking and a little different strategy. But as long as we're above that starting point of where we were at the start of year 1, when we kick this thing off, that's the measuring stick by which gains are going to be credited. And as you see this strategy, I think you're going to see an opportunity for this thing to have consistent crediting all the way across the board. So anyway, James, you can go ahead and jump in and give us that example you were going to show us.
Yeah, and I like what you said. It is a two-way street. I'm stealing the starting index is the benchmark of everything. I like that because John has a good way of kind of putting things in a nice format. And kind of like, let me give the same example again. If the index goes up 20% way up here, obviously we're getting the fixed rate on gain. But for the next 4 years, if it goes down 1% compared to there and down a little and down a little, as long as it's above that benchmark or starting, we're actually giving credit. So it's all about being above that index value. It's more about being above or below, not up or down versus the previous year. Well, beautifully articulated, John, if I can give you a compliment. So let's look at some hard numbers here. $100,000. This is our our highest upside, Liberty Mark SC. This has our highest fee. There's an administrative fee of $175. You're looking for a different, unique product with some real good upside and a real good guarantee. You found it. This is different. This has a built-in fee that buys a bunch of things for the client. It really buys upside potential. When you call Vision for that real results piece, net of fee, they're going to show you 15 to 30% returns from clients who were back in 2015 and 2016 in a low interest rate environment. They're getting phenomenal results. They're getting real big returns net of that fee. So to be fair, I want to bring up the fee because our declared rate on gain is check the rates and caps where you are currently. I don't know where you are in time, but it's a 5% interest credited on our top selling product, which is a great declared rate on gain. And to be fair, I'm subtracting our fee that does all these wonderful things. So really it nets out to about 3.25, or 100,000 is 103,250. So just from a declared rate on gain amongst the landscape, again, check your rates and caps, but to get where if an index is up, you get a declared rate of 3.25. It's very, very strong on just
I think
something that credits.
I think your closest competitor out there is going to be in the neighborhood of 2.5. So this is even net of fee. This is still a phenomenal opportunity.
Wonderfully said. And I'll give you a couple. Going through here again, our index is above the starting value. We credit 5 minus the fee. They're getting about 3.25. Same thing in year 3. Index is above the initial starting point. Year 4, this is ideal. Our index is up, and it's up 96 or 95% of the time, by the way. I'll show you here in a slide. But at the end of year 5, we finally completed the 5-year term. Now we're going to apply our par rate uncapped on the index itself and offer the big return. So here it is back to the initial point. You're getting annual crediting, everything you like about annual crediting going in there. Every year, a good rate, declared rate on gain that credits more than 95% of the time, 3.25, 3.25, 3.25, 3.25, and then you get the multi-year upside and the big return at the end of year 5. At the end of year 5, of course, you can reallocate and go somewhere else. You can put all or just a small percentage or any percentage or zero in the strategy, and then you can either reallocate or do another 5-year cycle. This example I'll show you is 0. We got a index is up. We're compounding on it, of course, cornerstone of the index annuity. We're getting 5. We're getting 5. In year 8, we went beneath that initial starting value, so we got a 0. And this, again, this index is going to hit, if you will, more than 90% of the time. Year 9 or year 4 in this 5-year term, or year 9 here, we got another 5, and then the big return at the end of year 10. You got the par rate applied, the gains, and you did net of fee. You did very, very well on this totally unique and different strategy. Multi-year upside with annual crediting along the way. There's nothing out there like this. This is new, innovative, and totally different. Let me show you here the hypothetical. Here's a historical occurrence of annual fixed rate. Because it's a fixed rate on gain, how often will the fixed rate credit? Well, it's got an amazing batting average. I mean, the good old-fashioned S&P and that annual point-to-point historically is what? Up 7 or 8 out of 10 years, 70, 80%. And we like that. We like that it's up 7 out of 10 years. Well, this back testing, we're looking at a 95+% batting average. That previous example where I had it credited every year here and we missed 1 year, it's right on track to what the index does. is you get a good batting average. We're going to give that declared rate a high percentage of the time, and then we're going to apply that big number, if you will, at the end of each 5-year cycle. The best of both worlds once again. Bringing it kind of together and with the illustration you're going to ask for from Vision or run yourself, or you're going to see, are a couple of things. Pardon me there. Minimum guarantee of 1.6 on 100. Again, put 100,000, that's 117,203. Worst case, no matter what, very quantifiable minimum guarantee. Our low last 10-year and high, we're looking at net of fee, 6, 7, 8, maybe you're in that average there. But what we're looking is to give somebody an annualized average over the cycle, a great minimum guarantee. Just think about those products from days past, or put yourself in the shoes of the client. They want guarantees, guarantees, and guarantees, but they also want a little upside potential for a reasonable rate of return. How many people out there, maybe including seniors, of course, would love to know about a product that's going to guarantee them, worst case, 1.6% and a shot at a reasonable rate of return with no risk because of the guarantee? There's plenty of people. There's tens of millions of people out there in our country who would love to see a product or have a product like this. Give me a guarantee and a shot at a reasonable rate of return. That will make me happy. And if it's on a paper and has some other things as well, nursing home bailouts and waivers, and it's just got a lot of good things built into the contract that are very client generous, I like to call it. Summary, it's the best of all worlds, and I would use that with the client. It's a fixed rate on gain that credits 95% of the time. You're going to see it on the statement, and it's going to be consistent. It's got that consistency, and then it's got the upside of a 5-year strategy. There's no moving parts when you do a 5-year strategy. That fixed rate and that par rate, everything's locked in, if you will, for the 4 or 5 years. So you got your consistency, you have your upside, you have a minimum guarantee, you got a paper. It really is, I think, a compelling strategy. And it's also available on the product that's got this new 7% bonus. That 7% bonus might help pay for that little fee along the way for many years. It definitely is going to do a lot. So we're going to have a really hot product that's soon to release, or if you're listening or watching on social media, get the current rates and caps whatever month you're in, because this product is going to be hot by then, or is hot right now, if I'll say. The index behind it, I want to give you an overview. When this is released, I'll have a lot more ammunition. I'll get Division advisors. So when you call them, it will give you a bigger and broader breakdown. I don't want to put you to sleep. Let's do a broad overview now. Let's dive in the specifics. But the big points from here, it's a powerful new index, and it's in partnership with Société Générale. You might guess where they're from. They're one of the largest European financials. I'm not going to sell them. They're A+, A1. They're massive, bunch of countries. They're big worldwide. It's the partnership of them and Columbia Threadneedle Investments. People, who are they? They usually look and go, oh, they're an Ameriprise financial company. I know who they are. I feel good about them. It's the combination of these two companies and legacy that's brought this completely innovative new index to the table. They're big. What makes it tick is it simultaneously employs some basic principles to get the results. I'll just give you the overview and the high-level thing. On the global investments, its index provides exposure to stocks and bonds from 3 countries, United States, Germany, and Japan, 3 of my personal favorites. And to further diversify, the index provides exposure to 3 global commodity sectors, agriculture, energy, and metals. When you call Vision to get the insert or the strategy description, it's going to go into greater detail, but it's stocks and bonds, it's got commodities, and it's able, due to this volatility mechanism, by moving the money around, this and that, what happens is the bottom line is it goes up 95% of the time, credits annual gains, has the upside uncapped to give a big number. So it does what you want. It's consistently up on a high batting average. The market state model, this is going to go into greater definition on those but it basically is looking at the different, the market states and moving, and it's using, it's rules-based and moving. Again, all these things as it moves money on a monthly basis, if you're curious to know, is it means it spits out or it goes up 95% of the time, and also has some nice upside potential on that par rate at the end of 5 years. That's what it does. We can go into how the watch is made more when you call Envision, or if we connect with each other. There's more information, but for now, this is what it does. It does a phenomenal job creating and heading north on a high batting average. So it's a powerful combination of fixed rate on gain. You're locked in. There's no moving parts during that duration. Participation at the end of 5 years. The model behind it, SG Columbia Adaptive Risk. There's the actual raw indexes in this 5-year strategy. So this is the Fusion, and we're also releasing just the raw index on a 1-year par rate strategy, where here's a new index that does a very consistent job. So that's good. I don't have the rates for that released yet, but basically one index on a 1-year par rate strategy, and the same index is on a totally unique and innovative 5-year strategy that gives you crediting along the way. Again, it's the best of both worlds. How does the product stack up? Well, we're available through age 85. Oops, that was backwards. The no bonus is through age 85. The bonus version is through age 80. Your 7% bonus through age 80. There's no income rider. This is just grow my money and do some great things. You can still annuitize old school if you're into laddering and things. You can grow it 5 years, annuitize. There's liquidity. There's a lot of surrender waivers, nursing home, things of that nature. There's an optional rider I want you to call Vision on. It's called the Heritage Maximizer. It's only 0.3%. Buys you a phenomenal death benefit. Call them. I can't give it enough love right now. It's got a great strategy selection, including this new Fusion, the 1-year, and some Morgan Stanley. A lot of good things on the upside. We got you covered on the upside potential. We got you covered on the worst case scenario. Everything goes perfectly wrong. You're guaranteed 1.6, better offer than what you're getting at the bank or maybe in some other product at the moment. It's on A paper. And then finally, we have the new illustration software that it's going to save you time or help us save time running it for you. It's easy to use. It's quick. And it has a real nice look to it, a new interface. That's going to make my job a lot easier and maybe some of the people at Vision. But we'd love for you to look and run your illustrations on legacynet.com or put everyone to work. We'll talk and run illustrations and comb over them together. So new illustration software as well. These are all right around the corner. You're first to kind of hear about it, if you will. They're coming soon. With that, compliance wants to say hello. And John, I'm going to flip it back to you.
Absolutely. James, if you'd be so kind as to go back to that one slide, maybe 4 back, where you were highlighting kind of the summary snapshot there. Just a couple things I want to point out right there. Yeah, if you'll hold right there for just a second. A couple things I want to point out, and I want to give you a quick visual. Ladies and gentlemen on the call, if you're thinking about a word picture to really explain this Fusion strategy, think about you being in the ocean, and you're swimming in the ocean, and you stop, and you're dog paddling. As long as your head is above water, you're above the benchmark. So no matter whether your chest and shoulders are out of the water or it's just the tip of your nose and you're barely breathing, as long as you're above the water, you're having an opportunity to gain a credit with this particular Fusion strategy that's out there. So that's a good analogy to explain to your clients if they need a visual of what that means. If we look at that initial starting point as the benchmark, that's water level. And as long as we're above water, we've got an opportunity for our clients to see a gain every year. And when we backtest this strategy, and I had a chance to spend some time with the actuaries when I was at the IMO conference and to kind of pick their brain on the algorithms and things they're using. And I like what they do, but I want to quickly point out as we wrap up, one of the reasons I like some of the strategies that Legacy is doing. And if you look at, in particular, the S&P. When a client buys the S&P strategy, which has been a bellwether that we've gone to for years and everybody knows it, but it's a passive strategy. And so if your clients have got money in the S&P and we see a correction in the market, there's no ability to change that indexing strategy because it's a fixed buy and hold strategy. And so if your clients are in an S&P strategy and the market goes south, guess what? They're going to get to ride all the way to zero on that strategy because that's as low as they can go in terms of an index crediting strategy on an annual point to point. Now, if it's monthly average or monthly punch to point, now you get into some of the other gyrations of, where volatility becomes a problem there. But the advantage of this fusion strategy, the advantage of the Morgan Stanley strategy, the advantage of the BNP strategy that we use in the FlexSmart product that's out there is the fact that these strategies are actively managed and they're multi-asset. So as James was saying earlier, and I want to make sure you get that, is that if market conditions dictate that they need to move geographically from Germany to Japan to the United States or wherever they may be in the particular index, or to move from one sector of the economy to another, they have the ability to do that during the middle of the year. So those actively managed strategies give your clients an opportunity to avoid riding a correction all the way to the bottom. And then it gives them a chance to start earning and growing their money even quicker on the backside. So there's some unique opportunity there for your clients to participate in these actively managed strategies that we're using through these index crediting methods to really have a chance to grow their wealth over time. That's why we're seeing the type of numbers and the type of returns that we're seeing in these products. So that's a huge and powerful selling feature to the legacy product portfolio. I want to make sure that you don't miss along the way. But the last thing I want to point out is that 1.6 minimum guarantee. To my knowledge, that is the best minimum guarantee in the industry right now on a fixed indexed annuity, is 1.6 on 100. That's a powerful strategy. And I love James's statement. If you can get 1.6 minimum guarantee, worst case scenario, with an opportunity to earn more and to get a reasonable rate of return, I mean, what more can you ask for in a product that provides safety, provides the opportunity for growth, provides the opportunity to be able to create guaranteed income out of that down the road? That's the solutions Legacy brings to the table. So we at Vision look forward to helping you run an illustration, showing you what these strategies look like, how they perform for your client, and giving you a chance to see the power of leveraging Legacy into your practice. So James, thank you for being on the call with us. Ladies and gentlemen, thank you for joining us. Our number here is 1-800-505-8489. Again, 1-800-505-8489. We welcome an opportunity to help you put together your next case prep, help you write some business, get appointed, and begin to use Legacy in your practice. Thanks for joining us, and I hope you have a great day.